y'all doing? This is Rich here on behalf of Rich TV Live, and I'm with a very special guest, David Moadel.
Hey everybody, how we doing? Glad to be back on Rich TV Live.
Hi.
The #1 place for cryptocurrencies, stocks, and now options.
Yes.
That's what we're going to be talking about today.
David, you are a scholar, my friend, and there's been a lot of members in our community that are showing a lot of interest in options. So I thought about it, and I'm like, who do I know that knows options? Who do I know that knows options? And I'm like, David Moadel. So I thought, why don't we do a show on options trading 101? Assume I know nothing about options. Anybody that's watching knows nothing about options. Let's start from the beginning.
Yeah.
Why would somebody, first of all, want to trade options?
Options are kind of like futures, if anybody knows those, where you get leverage. You get leverage. So, for example, in stocks, you need a certain amount of money to really make money.
Yes.
To make any appreciable amount of money, all right? I get people who come to me for coaching saying, yeah, you know, I only have a couple $1,000s. Some people only have $500. And they want to get involved in stocks, and they want to get involved in Netflix or Amazon or Priceline or something like that, Apple. Well, if you only have $500 or $1,000 or $2,000, and there's nothing wrong with that, that's totally fine. You can start with that. But how many shares of Amazon can you buy with that?
Not even one. Not even one.
Yeah. I mean, how many shares of Netflix? Maybe a few. Apple, maybe a few. And stocks, those blue chip stocks don't move that much. You might buy Apple stock and it might go up 10, 20% in a year. Hey, that's pretty good. That's great.
Yeah.
But if you only have $1,000, even if it makes 20% on your $1,000, what is that? That's 20 bucks. So, you know, that's not much of a plan there. So I'm sorry, it's 200 bucks. I'm sorry. But even if you make 200 bucks in a year, that's not really much.
That's right.
So what you want is some leverage, especially if you have a small account. You want to have some leverage. You want to be able to, leverage means magnifying your gains. You're magnifying your gains. So you might have 2-to-1 leverage, 5-to-1 leverage, 10-to-1 leverage. Now be careful, because with leverage, if you buy something and it magnifies the gains, it also magnifies the losses. That's what options do. They magnify the gains and losses. So let's say you buy Apple. You could buy Apple stock. You might make 10 or 20% in a year. That's fine, but it's not enough if you have a small account. What if you multiplied that by 5 or 10? Wow, now you're making some real money. But be aware, you can also lose that much, okay? The gains are magnified, but so are the losses. So be aware of that, all right? But with smaller accounts, I say options are almost a necessity. Now, another way to get leverage is through buying penny stocks, because they move faster than blue chip stocks. That's true also. But some people are not into penny stocks. Some people don't want to invest in small caps or mid caps. I get it. Totally cool. A lot of people just want to get involved in Apple, Amazon, Netflix, Starbucks, Disney, Coca-Cola, ExxonMobil, companies like that, the blue chips. But to get the leverage from those, options are the easiest way to do it. And what you need to do is if you want to get involved, you can go to your broker, whether it's TD Ameritrade. They're great with options. I use Schwab a lot. Fidelity, TradeStation, Robinhood now lets you do options trading. You need to get permission from them. Don't just assume that you're going to get to start trading options immediately. You have to contact them if you want to do options. Ask them for options permission. All right.
Oh, wow. I didn't know that. Options permission. I'm writing this down, just so you know.
Yeah, by all means. You have to ask your broker for permission to trade options. That's the first step if you want to get that leverage.
Okay.
Yeah, and there are different levels of options permission. They usually run from, let's say, 1 to 6 is typical. They usually have numbers. Where with options level 6, you're advanced. It's like doing calculus. All right, but do you want to jump right into calculus? If you're new, if you're not that good with math yet, probably not. You want to start with algebra, right?
Yes, yes. You want to start slow. Now, you did mention something, leverage.
Yeah.
Now, let's talk about the leverage. So you said that, and this is what I've been saying to everybody. Options, and I've said this myself, options are another financial instrument created by the financial institutions to make money. Like when you go to a casino, they don't just have blackjack. They got roulette, they got blackjack, they got all these different games. Options is just another game that's been created by the financial institutions to make money so that the house can make money. Would you agree with that or disagree with that?
I definitely agree with that. Most people who are beginners and try options don't do well because they're not doing it right. And I'm going to give some clues and ideas to help you do it right.
Okay.
But yes, the institutions usually win in the world of stocks and in the world of options.
Correct.
That is definitely true. So let's talk about that. First of all, what are options? They're contracts. All right. And most people start by buying these options contracts. You can also sell them. That's more advanced. That's a higher level of permission. When you first start out and ask your broker for options trading permission, they're probably going to start you at a lower level. They might start you at level 1, level 2. What does that depend on? Depends on your account size. If you have more money, they'll give you a higher level usually. So somebody who has $100,000 is probably going to get a higher level than somebody with a couple thousand. That's understandable. The broker is taking on some risk when they give you options permission because a lot of times they're loaning you money. Another factor is they're going to ask you how many years, probably they're going to ask you how many years of options permission trading, how many years of options trading experience do you have? I'm not telling anybody to lie. Don't do that. But I will say this. If you say I have no experience and I have no idea what I'm doing, do you think they're going to give you higher permission or lower permission? They're going to give you lower permission, and that's going to restrict your ability to do things.
Of course.
So you're going to have to put what's right for you, okay? Again, I'm not telling anybody to lie. Okay.
In other words, David is saying if you want to trade options, you got to say you've been trading them for 20 years. Read between the lines. He's essentially saying that if you say to them, oh, I'm brand new to options, they're not going to give you the keys. They're going to say, okay, here, we'll drive the car and you sit in the passenger seat. They're going to give you a little bit of protection, correct?
And they're probably not going to check up on you. How would they know whether you have, 2 months of options trading experience or 20 years? How would they know?
Yeah, they won't.
They're not going to come to your house and check on you. They can't read your mind. They're not going to check your other accounts. They're not. They're not going to ask your friends and your family. So, but anyway, and by the way, neither Rich nor I are licensed investment advisors or registered investment advisors. You have to make your own decisions. None of this is investment advice. We're not telling you what to do. We're just giving you information. Okay, had to say it. All right, so these are contracts. Now, a contract that gives you permission, gives you the option, that's why they're called options, an option contract that gives you the option of buying 100 shares of a stock is called a call.
Okay.
That's a call option.
Okay.
Call option gives you, if you buy one of these contracts.
So hold on one second. I'm writing this down. So a call option is when you buy 100 shares.
Well, it gives you the right to. You don't have to do it if you don't want to.
It gives you the right to buy 100 shares.
Yep. Gives you the option. Gives you the right if you want to. You don't have to.
Okay.
Okay. So now imagine you bought a piece of paper from somebody. It's digital nowadays, but imagine you bought a piece of paper. It's a contract. It's a legally binding contract. Gives you the right to buy 100 shares from that person, from the other guy or robot or institution algorithm on the end of that contract.
And how much is each contract?
It depends. Depends on a number of factors. Okay. I will say this. Buying a call option contract is much cheaper than buying actually 100 shares of stock. All right, I will say that. So that's so
because we just talked about it. You said that options are a way to get into bigger stocks if you don't have enough money. So
Correct.
I want to go back to what you said. You said if you have $500 and you wanted to buy, let's talk about what you talk about. If you have a $500 and you want to buy Amazon, how many options can I buy with $500 if I want to do a call option with Amazon?
Right now I'd have to look that up on my Schwab account, which I can do. But if you do a call spread, which we'll talk about later, you pick your price. It could be as little, I've seen call spreads as little as $50.
Okay.
And actually, there are call option contracts that even if you don't do a spread, they can be as little as $50. I've seen $5 calls.
Wow.
Call option contracts, but those are low quality ones. You're getting junk. So
that's like penny stocks, right? You're talking about penny stocks? Is that penny stocks? Okay.
We're jumping ahead. We're jumping ahead. So a call option contract gives you the right to buy 100 shares of a stock, of a particular stock that you and the other person on the other end of the contract agree on through your broker. You'll never meet the person on the other end of the contract. You'll never see them. You'll never talk to them. It's a very interesting contract with a person you won't know, and they'll never know who you are either.
Now, is that person a person who is selling a contract?
Mm-hmm.
So on the other end, it's another customer who is now selling their options to you.
Correct, and they're trying to make money too. The person who sold you the right to buy 100 shares of a stock at a particular price and by a particular time, there's an expiration date, okay?
Yeah.
So that's what's going on here. So let's pretend, Rich, I'm selling you an Amazon call option contract, okay? What is Amazon selling at right now?
Like 1900?
1900, okay. So, you know what, Rich? I want to make some money right now. I'll sell you for $300 a call option contract. It'll expire in 2 weeks from today. So it has it's like milk. It has an expiration date. Doesn't last forever.
Okay.
And it'll give you the right to buy from me 100 shares of Amazon stock at $2,000 per share. Okay?
Okay.
So for the next 2 weeks, so you're going to pay me $300 up front.
Okay.
You give me the cash up front.
Yeah.
As the seller, I get $300 in my account immediately. My broker places it right in there. Wow. So option sellers get paid money up front. Option buyers pay money up front.
Interesting. Option sellers get paid up front.
Yep.
And option buyers are fronting money.
Pay money up front, correct. Now, what did you just buy? Well, you bought the right, not the requirement, but you bought the right to buy 100 shares of Amazon from me. And we're assuming I have 100 shares of Amazon. Okay, I got a lot of money. I'm a rich guy or institution or whatever. And I have 100 shares of Amazon. Okay. I have to sell them to you whenever you want, whenever you tell me to. You can tell me anytime during market hours from 9:30 a.m. to 4 o'clock p.m. Eastern Standard Time. During those regular options trading market hours, you can tell me at any time whether it's reasonable or not. You don't even have to give me a reason. You can force me to sell you those 100 shares of Amazon at $2,000 per share anytime within the next 2 weeks. What if now, let's say 2 weeks go by, and at no point during those 2 weeks, you tell me to sell you those 100 shares of Amazon at $2,000. Then the contract expires. It's worthless. I got $300. You got basically nothing. You got ripped off.
Oh wow! So you lose your $300.
Well, you lost it up front. You will never get that $300 back.
So if I put an option that I think Amazon's going to 2,000 and it never gets to 2,000 in 2 weeks, what you're saying is I lose my money.
You lose your money anyway. You lose that $300 no matter what.
That sounds very risky.
But But
Yeah.
let's say within the next 2 weeks, Amazon skyrockets up to 2,000, past 2,000.
Yeah.
Do you think that that contract is now worth only $300? That call option contract is probably worth thousands of dollars.
So how does that work? Like, how do they determine your profit? That's what I'm trying to understand. Because I did futures trading, and it was crazy explosive.
Yeah.
I started with $5,000. I was trading almost 24 hours a day. It's crazy. It's like 6 days a week after market you're trading. And I went from $5,000 to 8,300. I'll never forget this. And I thought I was the best thing since sliced bread. I stopped listening to anybody. And then I got caught up in a whole bunch of trades, got a whole bunch of margin calls, and I lost it all in like days. It was obliterated. And I was like, what just happened? I didn't even know what happened. It was the craziest week of my life. It was 1 week.
That was 1 week. Unbelievable.
That was crazy.
Its options are very similar, but here's the good news. Here's the good news. The most you could lose on this trade is the $300 you paid for that contract. Okay. The worst thing that could happen is you bought a worthless contract.
Okay. Yeah.
You cannot, if you just buy, a call, or later maybe we'll talk about call spreads. That's more into calculus. Okay, it's more complicated. But so now, let's say you buy. All right, so Amazon right now is $1,900 per share.
Yeah.
You bought the right during the next 2 weeks. You paid $300 up front, and you bought the right to buy 100 shares. And it cannot be less than 100 shares. You got to buy either the 100 shares or nothing. You can't split it up. There's no half contract. Okay. Can I just buy a few of those 100? No. It's 100. It's all or nothing. Okay. You have the right to buy it at what's called the strike price. They call it the strike price.
Buy at the strike
That's the agreed upon price that I have to sell you the 100 shares at anytime you tell me to during the next 2 weeks.
So the 2,000 number. I give you a number of 2,000. That's our strike price.
Right. And on your broker's website, on their platform, they'll give you a whole menu of strike prices. You don't have to choose 2,000. It could be 1,950. Could be 1,975. Could be 2,200, whatever it is. Also, you negotiate the expiration date. It doesn't have to be 2 weeks out. There are call options that are a few days out, which is very risky, by the way. Those are the cheap ones, because now you're betting that Amazon's going to go up within the next few days, which may or may not happen.
So this is really good if you've got, like, for example, the cannabis stocks. They're super hot right now. It's in a full bull market. We know that legalization is coming in Canada in 50 days. The market is literally in the green every day right now. Canopy Growth, for example, would probably have been the best options stock ever, because it's literally gone up for 500% since November. It's gone from $6, actually 1,000% since November. It's gone from $6, September. It gone from $6 to $60 here in Canada. So it's up 10 times. So you could have made a fortune buying options, correct? With that.
Well, here's the thing. with marijuana stocks in the United States, because the United States options market has not deemed them legitimate enough yet, they are not optionable. Marijuana stocks are not optionable yet. Don't be surprised if in the future, when they gain a little bit more credibility in the eyes of the big wigs in the options markets, then finally they might become optionable. Right now, no marijuana stocks in the United States have options.
Really?
That's true. That's true. Only it's right now. It's just blue chips.
I had heard there were American guys telling me they were buying cannabis options right now.
No.
So those guys are lying.
There are no options available on marijuana stocks.
Interesting.
Yeah.
Interesting.
Not yet. Maybe someday.
Okay.
At least in the United States.
Okay.
All right. Now, hopefully that'll happen. Options are available on any blue chip stock you can think of.
It says it's available. It says it's available on Robinhood. Apparently, one of the guys in the group just messaged saying you can trade options on Robinhood. I don't know. Like I said, I'm new to options. I'm just going by what I've heard. Right.
You can trade. Yeah. Well, I'm going to check my Schwab account right now. As far as I know, I don't want to give misinformation.
Yeah, I just want to know for sure, because I have American members that have been saying that they have been buying cannabis options and making a fortune. So I'm very interested in learning more because I want to make a fortune too, right?
Yeah, no, I hear you.
And based on the momentum that's happening between Tilray's ridiculous today, over 20%. Cron, on fire. Canopy Growth Corp on fire. All these stocks are crazy on fire right now. They may be amazing options trades just because they have so much momentum based on what you're talking about.
I'll tell you what, Rich. It depends on which one. For example, I just typed in Agritech Holdings. There are no options.
How about Canopy? Can you type in Canopy Growth Corp, CGC?
That one does.
So CGC. So you can buy options on CGC.
Yeah. Okay. They're on the NASDAQ now. So yeah. Okay. Fair enough.
So you can buy options in America then.
Okay. Yeah. So I take that back. There are some.
Okay. Good.
Let me try Afria. Nope. Yeah. Aurora. Nope.
How about Tilray, TLRY? They just went onto the senior exchange.
Nope. At least not on Schwab.
Wow. So just Canopy, eh? Just the one. Interesting.
Again, keep in mind they're on the NASDAQ, so they have a certain level of legitimacy.
That's right. They're actually on the New York Stock Exchange. They're on the New York Stock Exchange.
Oh, I'm sorry, the New York Stock Exchange. I'm looking for other ones. Yeah.
It's probably just
Organogram.
It's probably just Canopy.
Yeah. If the people in the chat want to tell me which ones that they're able to trade options on, let me know.
Operation Property Preservation is saying CGC, Cron,
okay, right,
MJ, IIRP, and TLRY. But he may be using a different account.
TLY, Tilray Inc.
No.
Tilray has a few. Yeah. Okay. Tilray.
How about Cron? CRON. Oh, brand on paper is saying I've got Tilray on E-Trade. So apparently you can buy Tilray options on E-Trade. And Tilray must be just crazy for options because have you seen Tilray today?
Yeah.
It's at $55, David. They IPO'd around 20.
Wow.
A month
Nice.
ago.
I'm typing in Kronos Group, according to Schwab at least. Let me see. Yeah, Kronos does. Okay.
So I guess some of the bigger stocks you can trade options on.
Yeah, but if you do like Agritech, TerraTech, a lot of the really popular ones, you just can't. Wait, what is it? Emerald? No.
Yeah, I guess it's for like the biggest ones on the senior exchange.
Yeah, Emblem, Organogram. Nope.
So let's take a look. Let's take a look at one. Can you pull one up? Can you pull a Canopy? Can we use some real numbers? Let's say someone wanted to trade Canopy right now. And if you pulled it up on your Schwab account, what kind of options would they have? Let's just say they had, $500, for example. Would they be able to buy 100 contracts of Canopy?
Well, okay. No, you don't want to buy 100 contracts. One contract represents the right to buy 100 shares.
Sorry, one contract. One contract to buy 100 shares. That's right. So
all right. Now the strike prices on CGC, Canopy Growth Corp. Yeah, how far out would you want to go? That's the question. If you use an expiration date that's really soon, you're taking a big chance, but you could make huge amounts of money. And those options are really cheap.
Okay.
Because think about it. What's going to be more expensive? A contract with just a few days left on it, like milk that's about to expire, or a contract with weeks or months left on it? Certainly the right to buy something for the next few months is going to cost more when you buy that contract. That just makes sense.
It's buying you time.
You're buying time. Well said.
So let's say, for example, you think that Canopy Growth Corp is going to go up between now and legalization of cannabis. You've got about 6 weeks. Could you say...
I've got October 17th slated for that.
Correct.
There's an October 19... There's a menu with a bunch of expiration dates. Okay. Let's say I choose October 19th, okay, as the expiration date.
Okay.
Fair enough. Now, right now, it's about $47 a share.
Okay.
What do you think it's going to go up to?
Let's say you think it's going to go up to 50.
Okay. That's pretty reasonable. That's, I mean, that's not asking much. It's already 47.
Can you make good money if it goes up to 50, or is that not enough of a spread?
It's not enough of a spread because you're not taking a big chance there.
Okay.
Now, those options contracts are about $400 each. Okay.
400 each. Okay.
400 each. They're kind of expensive. Why? Because this is likely to happen. It's probably going to go up to 50. The guy selling you the contract is saying, "Oh wow, geez, I'm probably going to have to sell him those shares. It's probably going to get there. So I'm going to make this guy cough up a lot of money." And he's going all the way out past October 17. He's going October 19. So can you see why the guy would charge a lot of money for that options contract, that call option?
Because he knows it's very likely that you're going to win that trade.
It's likely to go past 50. You win if it goes past 50. And the further it goes past 50, the more that call option contract goes up. And you could resell that call option. You could buy it for 400. Canopy goes past 50, and you could sell it for 1,000, 2,000, whatever it goes up to. Depends how high Canopy Growth Corp goes.
So when you say I can sell it for 1,000 to 2,000, what do you mean by that? Explain that.
Okay, so you bought a call option contract that we just talked about, Canopy Growth Corp, expiration date October 19, strike price 50 per share. All right, right now it's trading around 47 per share. You bought it for $400. Now you can resell these things because you might be saying, "Well, Dave, I don't really want to buy 100 shares of Canopy Growth Corp stock. I can't even afford it. That's like $5,000, right? It's like $5,000 or almost $5,000. Well, if you buy 100 shares at 50, it'll be $5,000, right?
That's right.
You might not even have that, or maybe you don't want to buy 100 shares. Guess what? You don't have to. You can buy the right to buy 100 shares, that call option contract, for around $400. It's like $438 right now. Okay, so for around $400, let's say the price of Canopy Growth Corp shoots up past $50 a share. Now that contract that you bought for $400, now it's worth, I don't know, $800. You double your money if you sell it right now.
And it shows that in your account. It'll say, okay, this is worth $800 right now. And then if you sell it, it's automatic. It's just like equities. I can just sell it and I get that price. Okay.
Anytime from 9:30 a.m. to 4 o'clock p.m. Eastern Standard Time, you can sell it.
Okay.
Okay. So what's cool about that is that you get almost the same profits, not quite, but almost the same profits as somebody who bought and sold 100 shares of the stock. Almost. Here's the disadvantage. You have an expiration date. Okay. If you buy 100 shares of stock of Canopy Growth Corp for $4,700 right now, $4,700, and let's say it doesn't go up by October 17th, but you want to hold on to it past the expiration date, past October 19th, you can. You could hold it for years or even decades, as long as you want.
And that's if you're buying equities. You're saying if you're buying equities, correct?
If you buy stocks.
Yes.
With options, instead, okay, here are the pros and cons. With the stocks, you'd be, let's say CGC. With the stocks, you'd be risking $5,000 or $4,700 because you'd be buying 100 shares of stock, right?
Yeah.
You've got $4,700 at risk and also tied up. You can't be spending it on that money on other things as long as it's in the stock, right?
Correct.
So by buying the stock, you need to have more money in your account. You're risking more money up front because you're risking $4,700 instead of $400. And you have an expiration date. You have to be right by a certain time. You can't just hold on to it and let it work itself out in your favor over years. So those are the disadvantages of options compared to stocks. The advantage of stocks, you're risking a lot less money. You've got $400 on the chopping block and tied up and unusable, only $400 as opposed to $4,700. People with smaller accounts, maybe you only have a couple thousand in your account and you cannot afford to buy 100 shares of the stock. Buy a call option. Okay, you can do that. And you can get in with a few $100s.
Interesting. Right? So what I'm hearing, which I find very interesting, is that options are extremely risky.
Yes.
However, you can make almost as much money with options as you can with stocks with a fraction of the money.
With a fraction of the money up front, but you have the expiration date to deal with. There's no free lunch in the market.
That's the negative part of the options. The positive is you can make a lot, especially if you make the right pick at the right time and it goes up. You can make a small fortune on a small amount of money. But the negative is because you have this date, you have to be able to fulfill your transaction before that date, or you lose all of your money.
Correct.
Okay.
How do you fulfill your transaction before the expiration date? You could either tell the guy, hey, I want to buy those 100 shares of stock, if you can afford it, if you can afford to buy the 100 shares. Most people don't do that. Very few people actually exercise their right that's spelled out in the contract to buy 100 shares of stock. What do most people do? They resell the contract. It's like a game of hot potato.
They just move it to the next customer.
Move it to the next customer. So most people, rather than take ownership of 100 shares of stock and exercise their contract, what do most people do? They either resell it, so buy it for $400, and then hopefully it goes up to $600 or $800 or $1,000 or $1,500, whatever, and then just resell it to some other guy, or they just let it expire. Because as time passes, if CGC stays the same, like flat or goes down, as time goes by, there's less time on the contract left. And so guess what happens to the call option price? Goes down. It goes down. Okay? Because right now,
so does that mean you would owe money to your broker?
No.
Okay.
The most you could lose is what you paid for the call option contract.
Okay, good. So it's not like shorting where you could potentially go bankrupt in your account, right? And owe the money to your brokerage. Okay, good.
That cannot happen when you buy a call option contract. So let's say you buy one call for CGC stock, the right to buy 100 shares by October 19, strike price $50. Right now it's trading at around 47, the stock, right? You buy for $400. Let's say CGC stock goes sideways. It stays at 47. Day after day, week after week. October 19th is getting closer. The value of your contract, your call option that you bought for $400, if you were to resell it, now it's only worth $300. If you were to now it's only worth $200. Now it's only worth $100. Why? Because there's left time until expiration.
And they know that you're getting desperate. So they're going to give it back to you for cheaper because it's kind of like supply and demand. Right? Exactly.
That contract is worth not as much because there's less time till expiration. Okay? Contracts with more time till expiration, they're worth more.
Of course.
Okay? You're not as desperate. But when there's only a few days left, what you bought for $400 might be worth $20, $10, $5. I've seen it. Okay?
Now, have you ever let an option expire?
I have. Does
it make you feel
sometimes,
sick?
Sometimes your luck isn't so good.
For sure, of course.
You have bad judgment.
You thought maybe on the last day it was gonna bounce and it just didn't, kind of thing. You thought when you're waiting on some news, thinking it might go up. Is that kind of what could happen? I'm just in my mind thinking what goes through your head.
You know what? Especially if you buy a call option. If I bought a call option today that's going to expire in a couple days, let's say I'm feeling it's called a lotto play, right? You gamble a little bit. And those short-term call options, they're only like $50, $20, $5. And if the stock shoots up right after you buy it, it might be worth a few $100s. So if you feel like taking a chance, it's very risky because you could lose 100% of your investment with any of these. But so you let it ride until the end. Okay. Sometimes you can do that. I mean, you can do that anytime you want, but sometimes you do that. Now, let's say. So if CGC stock goes sideways, what you have is a melting ice cube. The value goes down slowly. It decays. It deteriorates a little bit because there's less and less time till expiration.
I understand.
Whereas if you own stock and it goes sideways, do you lose anything?
No, you can hold it forever.
You don't lose anything when the stock goes sideways. The person who bought the call option, it's a melting ice cube. So you really need that stock price to go up before the expiration date. You really need that.
Now,
and you
remember, I talked about this earlier. I said these options, futures, Forex, These are all tools that have been created by the institutions, by the banks, so that they can make more money.
Yeah.
Now, options reminds me a lot of futures. Huge upside, huge downside, but massive upside. Like, I know people that trade futures that are very wealthy, okay? Like, extremely wealthy. But they have a system. They follow their system, and they do not deviate from it. The mistake I made when I traded futures is I was all over the place. I had no system, no structure. I was just all over the place. I thought I could figure it out, and I got obliterated. I learned from that. Do you have a system that you follow for trading options? Do you have like a system that like for example, how I buy stocks? I buy in the red, sell in the green. If I see 10% or more, I take it. I have no emotion, and I very rarely take a loss. I would rather lower my cost average and wait for an explosion, and I trust my research. That's kind of my trading pattern. Do you have a system that you follow for your trading?
Thank you for asking. Great question. Well, people can email me at David Moadel, M-O-A-D-E-L, davidmoadel@gmail.com. I can help them put a system together. I've done that for a lot of people. davidmoadel@gmail.com.
Great.
And so we don't have enough time now to go through the whole system, but I can give some pointers and guidelines. And everybody's system is going to be a little bit different. Depends on your risk tolerance. Depends on your account size. Oftentimes I'll get people on not only buying calls, but buying call spreads, where you buy a call option and you also sell a call option. That's like calculus. That's a little more advanced. But for today, we'll maybe just focus on buying a call option. We'll just keep it simple. Just to give a little preview of other things that we can talk about, if you want to bet that a stock is going to go down, you can buy what's called a put option contract. It's better than shorting stocks, I think, because when you short stocks, when you short sell them, like Rich pointed out, you can actually end up owing the broker more money than you have in your account. Okay, you might have to sell your house or your car or something like that. When you buy a put option contract, it's just like buying a call option contract in that the most you can lose is whatever you paid for that contract. All right?
So that's definitely better than shorting.
I think so. I think it's
for
less
sure.
risky.
It doesn't have that downward negative where you could lose more than what you put in.
Correct.
That's
Well said.
Scary as hell. And that's why I don't short.
Scary.
That's why I don't short stocks. Even though it's very lucrative. I know lots of people that make a lot of money shorting stocks. I know a lot of people that's all they do is short stocks. And they make a killing. But if you short a stock like Canopy Growth Corp, you could lose everything. Because that is the short squeeze of the century, right? Like you buy Canopy Growth at $6, you short it, it goes to 60. You've just lost. I don't even want to know how much you just lost. Way too much money. So very risky. So this does seem like it's way better for shorting, which if you want to do shorting, this might be a better option for you. A put option contract betting a stock could go down.
Yes. Yeah. Now, you still have all the other problems associated with the call option contracts. There's an expiration date. You have to be right by a certain time.
So let me ask you a question on that point. What is your usual expiration date? Do you give yourself 2 weeks? Do you give yourself a month? Like, do you have a pattern? What's your strategy there?
Sometimes I just feel like doing a little gambling. I might buy something that expires in a few days, a week, 2 weeks. You can actually make big money doing that, but I don't recommend that for most people unless you want to gamble $50, $100. I've seen them as low as $5. Okay, if you feel like gambling, if you're just in the mood, you can do it. You can turn $50 into possibly $500. It happens. Or you can lose your $50. More often than not, you're just going to lose your $50 because what's the likelihood that within the next day or two the stock is going to shoot up?
Exactly.
If you look at stock charts, what do they do most of the time? Shoot straight up or shoot straight down? No, most of the time they're just sideways chop, right?
Yep.
And when you buy a call option or put option and the stock just goes sideways, melting ice cube.
You're burning money.
It goes down in value, and then it goes to zero on the expiration day at 4:00 p.m. Eastern time. So that's taking a big chance. What do I usually do? What's my main bread and butter? I like to buy call options on great companies when they're down, and I give myself plenty of time until expiration, 3 to 6 months, between 3 and 6 months.
So let's say, a great company that's down. Let's talk about Tesla. Perfect example.
Cool. I'm going to type in Tesla right now.
Tesla has been on fire. Elon Musk came out and said that he wants to take them private. Now they came back out and said, no, they're not going to take them private. So I think they're going to go back up. If I thought that Tesla was going to go back up, I could give myself a call option contract.
Call option contract
to buy.
That's the right to buy 100 shares.
100 shares.
But you probably won't. You probably will not actually exercise your right to buy 100 shares because that would cost you, $30,000. You'd be buying $30,000 worth of stock. You can if you want to. You can tell the other person on the other end of that contract, hey, sell me those 100 shares right now before expiration. Most people don't do it. You're probably just going to resell it. You're going to probably resell that call option contract to some other person. So it's called the greater fool theory. You're going to sell it to somebody you think is foolish. And whoever sold it to you thinks you're foolish, right?
Totally.
So
it's like game within the game. It's very interesting.
It's a game. But aren't stocks that way also?
Of course.
Like you're buying stocks from somebody who thinks you're a fool, and then you sell them at a higher price to somebody you think is being foolish.
Absolutely.
So now here's the menu. You can buy Tesla call options expiring August 31st. That's what I call lotto play. Okay. And those, now it depends how high you think it's going to go. Let's say your strike price, your target price is, $3.25, right?
Okay. And what's the price right now?
I just lost it. $3.17, I think.
$3.17. And your strike price is $3.25. Okay.
Yeah. Let me type in Tesla. There we go.
And you're giving yourself 4
$3.16.
days. You're giving yourself 4 days till August 31st.
Yep. So okay, right now, I'm sorry. It's about $316 per share.
316. Yeah. Okay.
And we're going to bet. We're going to do a little bit of a gamble, a big gamble. That's going to go up to $3.25 by, let's see, and Schwab is not working.
In 4 days. That seems to me extremely risky.
That's very risky.
Yeah.
But, I mean, think about...
if they had some big news or something.
If they had some big news.
Yeah. Like if some big news was coming out and you knew the earnings was coming out, that might be a bet you want to put in. But like you said, it's hugely risky and it's just a gamble.
There we go. I finally got it working. Okay. How much do those cost? Around $350.
Okay.
Per call contract. That's kind of expensive, but think of how expensive it would be to buy 100 shares, $30,000.
Of course.
I'd rather pay $350. I'd rather risk that than risk $30,000. But on the other hand, the expiration date is in a few days. You would need it in the next few days to go up past $325. Okay, it's not good enough if it goes up to $325. You need it to go past. Really, you need it to shoot up
so you can make some big money. Now, let's just say it goes to $326. How much money would you make on your $350 investment? Do you know that yet, or would it be impossible to determine that?
It's impossible to determine because the options market, they have all these. It's called the Black-Scholes model. They have like this big mathematical model that they use for calculating options prices. Very complicated.
Wow.
It's only for engineers and people like that.
They've got their own algorithm.
Yeah.
They've got an algorithm. That's interesting.
There is a formula. You can look it up on Google. It's called the Black-Scholes model if you're interested, but you don't need to know it. It depends how soon it shoots up and how much. Okay. If it shoots up a lot very soon, the call option contract you bought for $350 could be worth $1,000, right? You could literally triple your money. Or it could be worth $600. You could double your money, $700. If it takes a long time, like the entire time until expiration to go up, then it's not going to be worth as much. Because remember, you want there to be lots of time left. That adds value to your contract, right? So you want it to go up soon and a lot. Okay, if it only goes up to 326 and it takes almost till expiration for that to happen, you're instead of being worth 350, it may be worth very little, not much more than that. Okay, it could actually even be worth less than that in some cases because the ice cube has melted so much. Yes, the price went up, but so much time passed, and there's so little time left on the contract. Your $350 contract might be only worth $100. I mean, it's the options market decides these things based on how much time is left. They like it when there's a lot of time left. That increases the value of the contract. The momentum of the stock, the emotion of the markets, the sentiment. A lot of things are factored in. The volatility, the volatility of the stock itself, how sharp the moves are, how big they are. That's a factor in there. So the Black-Scholes model includes volatility, time left, current price of the stock, strike price, all those things. How many days left till expiration? These are all factored in. So there's no way to predict what it's going to be worth, unfortunately.
It would be nice if they had and maybe they'll do this in the future, some type of way to say, oh, if it hits 50, if it hits $327, you make X amount. If it hits 300, they don't do that. Nobody does that.
Those values change constantly.
Okay.
Constantly.
It's impossible to predict.
It's impossible. But we do know that if the price goes up, the call option contract price tends to go up, unless a lot of time goes by. Then it can actually go down even if the price goes up.
Really?
People come to me. Yeah, the amount of time left, I would say, is just as important as the price of the underlying stock.
Wow.
Because the options market looks at both. Okay? It's not very encouraging to the options market if Tesla goes up to 326, but there's only half a day left on the contract when there used to be a lot more time. Okay? So yeah, the time is just as important.
Man, these institutions are just making money everywhere.
Yeah.
They're just scalping you everywhere. Yeah, I see what's up here, man. This is a money-making machine for the house. Oh, it's a money machine.
Goodness. Yeah, it is. But if you do it smart, okay. So I don't recommend in most cases, unless you feel like gambling, which is fine to do once in a while for fun. If you don't mind losing $50 or something, or in this case, $350. But that's because it's Tesla. When you have a more expensive stock, you have more expensive options. So Amazon options are going to be very, very expensive. Netflix, Apple, a little bit less expensive. Ford, something like that, is a much Freeport McMoran, something like that, is going to be a much cheaper option because it's a much cheaper stock. All right. Let's look at the Tesla example. Let's say you gave yourself a lot more time. Let's say I wanted to give it 3 to 6 months. What is it now? It's late August, September, October, November, December. Let's say I gave it 4 months. Let's say I gave it until December 21st. That's on the menu. Okay.
Okay.
Same strike price, $325.
Okay.
This is a very expensive call option. $3,200 per contract, $3,200.
Because they know it's very likely.
Do you now see why the time is just as important as the price?
Yes, because it's very likely over that 4 months that it's going to hit that at some point, and you will be able to make money.
Of course.
So you're going to have to pay if you want it. It's like if you're gambling on sports. Like if you're picking the New England Patriots to win every week because they've got Tom Brady and he just wins all the time, you're not going to win as much money if you pick New England because they're always favored. It's the same thing. It's following the exact same rules of gambling on sports, essentially.
Yep.
That's what it reminds me of.
Yep, exactly. Let's look at a put option just for fun.
Sure.
Let's say you think Tesla's going to go down. Let's say you think Elon Musk has lost all credibility now. Whatever he says, don't believe it, or Tesla is overpriced. Whatever you think. I'm not saying these things. We're just pretending. What's a good strike price, Rich, for that? What do you think it's going to go down to, and by what day?
Well, based on the fact that it's at 316, I would say it could go to 300, which I don't believe it will. I think it's going to go up. But if I was gambling it was going to go down and I had a feeling it was going to go down, I would say it would go to 300 in the next 4 months.
4 months. So December 21st is on the menu. I'll pick that one. You're never going to get, or rarely going to get, the exact date. They give you a menu of dates.
Okay.
And there's usually a couple of days per month in there. All right.
Okay.
So let's say 300 strike put options, right? Let's say you buy one of those.
Yeah.
expiring not until December 21st. On Tesla, that is about the same price, $3,200. Isn't that interesting? About the same price as the call option we just talked about.
So it's just as likely that it'll go to 300 as it is that it'll go to 326. Because over 4 months...
According to the options market right now.
Because it could go up or it could go down. It's kind of... It's a risk. It's like anything. It's a risk. It could go up, it can go down. That's just the markets. Makes sense.
Isn't that interesting?
Totally makes sense. I was expecting that. Because if it was saying, oh, it's only $500 to bet the short and it's $3,200 to bet the long, in my mind, I'm pretty much saying this is going up. Everybody's expecting this thing to go up, right? Right. So that's kind of what my mind. But now, based on the fact that they're pretty even, it as an investor kind of shows you that it's not showing you what to do. Which I think the house wouldn't want to do that. Correct. Right? Why would the house want to show you an advantage for you to be able to win money from the house? Right?
Exactly. Just a quick definition. Okay, so a call option is the right, but not the requirement to buy 100 shares of a certain stock, agreed upon stock at an agreed upon date, buy it by an agreed upon date, the expiration date, at a particular price called the strike price. A put option, this is almost the same definition, is the right to sell 100 shares of stock. Not buy, but sell 100 shares of stock at a certain price by a certain expiration date. It's still called the strike price, expiration date, same thing. But again, most people don't actually sell the stock, 100 shares, okay? Most people don't even actually own 100 shares of stock, and you don't have to buy a put option, okay? You don't have to own 100 shares of stock to be able to sell in order to buy a put option. Your broker, if you get permission, will let you buy one anyway. Okay? Because you could always buy 100 shares of stock and then sell it later if you want to. But most people don't do that. Most people, like a hot potato, just resell the option before the expiration date. Or if they have bad luck and it expires worthless, then it expires worthless. That happens sometimes. That's life. All right? You can resell your option any day before or on expiration during market hours, during options trading hours. All right. So don't think you have to hold it till expiration. Most people don't. Very few people do. unless you buy something that's going to expire in a day or something, then you might hold it till expiration. But even then, you don't have to. You can sell it halfway through the day, whenever you like. Now, you have to make a decision. Part of it, you talked about having a plan. First part of the plan is only buy call options on stocks that went down. Okay? All right, buy in the red, sell in the green. That's what Rich tells you when he's right. Because what do you think happens to the price of the call option when the stock goes way down? The call option price goes way down. Okay? Because it's less likely to reach that strike price. So you're still buying low. And then you hope to resell it higher. But again, you need that stock price to go up soon. It's not enough that it went back up. You need it to go up soon, right? Because it's a melting ice cube. Yep. You could have the stock price go up, but the ice cube's melting because there's less time left now. And so again, people write to me all this, and they call me. They say, Dave, I bought an option. The stock went up. The price of the call option went down. I said, well, it took too long. You know, you bought it when there was 2 months left till expiration. Now there's only 2 days left till expiration. Really sure, the price of Tesla went up, but not fast enough.
Yeah, that reminds me so much of futures trading, which I hated, is if your account went down 30%, you automatically got margin traded, and you lose 30% of your account, even though the very next hour it could be up. And I'm sitting there calling up my broker going, why'd you do this? Now it's back up. Oh, too bad. We had to protect you. How do we know it wasn't going to go down further? I'm sitting there going, this is crazy. So the house is making money all over the place to protect themselves because they don't want to see you get obliterated. But at the end of the day, they are obliterating you by forcing you to take a 30% margin call. Even though the very next day, it could go back up. And it happened to me so many times when I was trading. I got so frustrated. Then I started revenge trading. And I was just like, this was... My futures trading experience was nothing short of a nightmare. It was nothing short of a nightmare. So this seems a lot less risky, which is exciting. I
Yes.
think it seems like something I definitely want to get into. I want to start trading some options a little bit. Maybe we can do it together. Now, I have a
Cool.
good question from Attila. Thank you, Attila, for watching. Everybody that's watching, thank you for watching. I really appreciate it. If you guys could smash the like button, share this video. We really appreciate it. It helps these videos go viral so everybody else can learn about options as well. Attila had a good question. What tools can you use to help you decide before you're buying options? Do you use any websites or any tools to give you guidance?
You know where my guidance comes from is from experience, paper trading it for a long time and then doing it for years. And I coach people, get a mentor, I always say. But, and again, people can contact me, David Moadel at gmail.com, last name Moadel, Moadel, 1L. And as far as websites, you know, I don't really see any websites that I trust to tell you what to buy and what to sell, as far as like websites with a paywall, that kind of thing. Rich has some amazing picks, and he's not charging for that. And he's a lot more accurate than a lot of those pay sites. So I would say be careful of those.
Do you ever use like investing.com for their technical indicators or barchart.com? I use both. I really like using their technical indicators. When I see a stock is 100% buy, top 1% signal strength, it's usually a sign like 90% of the time that they have a lot of momentum. And if you want to just do a momentum trade, you can very easily at times get 5 to 10%, sometimes hundreds of percent following momentum trade. I'm not really a momentum trader, so I'm more of a long-term investor, but I have done it in the past, and it can be very effective. But like David said, none of these indicators are 100%. Nothing can guarantee what could happen in the marketplace based on bad news, based on bad financials. One company that just turned around is CVSI, CV Sciences Inc. It was on fire, went from under $1 to $9, and then a press release came out that they were being sued by Andrew Left. The stock tanked. It's now at $4. Anybody who bought it at $9, they got hurt. So if you're a momentum trader, you can chase those types of deals, but at some point, if something bad happens, like a piece of news comes out, that's all it's going to take to tank the stock. And a lot of times, it's manipulation that causes these shorts, these crashes in the market. And CVSI was 100% buy, top 1% on bar chart for over a month. And it just kept going up and going up every day. And then eventually, bar chart didn't predict it was going to go down. It just went down. And even though it went down, bar chart still had it as 100% buy, top 1% signal strength. Because those indicators are not future indicators of bad news. They can only give you indication of what's happening right now based on buying and selling pressure. So if something bad happens that's unforeseen in the future, bar chart can't predict that. They can't. They're not predicting bad news.
They can only tell you what happened in the past and what's happening right now. That's it.
Correct.
So please be careful of that. Yeah, I like Barchart a lot. Barchart.com, Finviz, Finviz.com. They have a lot of free resources on there. But just, you got to make your own decisions at the end of the day. And, of course, richtvlive.com, tons of resources on there. He's got charts on there. He's got his winning picks on there. And he doesn't even charge. So, check it out by all means. I just want to give people a little idea of some low-cost things you can do with options. Let's say you think Ford. Because the stock is cheaper, the options are cheaper, right? Ford is like how much is Ford? It's like a $10 stock right now.
Yeah, I think it's $9 or something. Last time I looked.
$9.98.
The symbol is F, correct?
The symbol is F, correct.
Yeah.
Let's say you thought, okay, Ford is going to go up to $10. That's not asking much. It's $9.98 right now. It's 2 cents away. You're not asking much. You think it's going to go up to $10 by, let's say, December 21st. That's between 3 and 6 months out, which is what I like to do. Okay. Very, very cheap. Less than $50.
So you buy a call option to buy Ford 100 shares.
You have the right to buy Ford, 100 shares of Ford stock, or to resell, more likely resell this contract until December 21st. So that's about 4 months.
Yeah.
And the strike price is $10 per share, which it's almost at right now. It's $9.97. And you're going to pay $48, less than $50.
Because they know that it's very likely it's going to happen.
Yeah, well, I mean, that's
why
pretty
it's
cheap.
so cheap, right? Because it's very likely it's going to happen.
Now, why is it so cheap? Well, because Ford is not a fast mover. Oh. When the stock is less volatile, the options market has more subdued prices, lower prices for the options. And so now we've talked about the 3 factors that affect options prices. And these are all in the Black-Scholes model. What are the 3 factors that affect option prices? The price of the stock, of course, right? But that's not the only one. Time, how much time left till expiration. That's just as important as a stock price. The third one is the volatility of the stock. If a stock just doesn't, it's not a big mover, like Ford's not a big mover, okay? It's not like a marijuana stock that moves a lot. So the options market decided, yeah, I mean, is Ford probably going to go above $10 before December 21st? Yeah, probably. It's only 3 cents away. But is it going to go a lot past it? The options market says, nah, they decided no. It's probably not going to move much past 10 because it's just not a big mover. They might be right. But if you believe that Ford will go a lot up above 10, you could make some good money with this, all right? And you have until December 21st. I like to buy 3 to 6 months out because I don't have a crystal ball. I don't know what's going to happen in the next few days or even the next couple of weeks.
It gives you more time in case you were wrong.
In case you were wrong, which sometimes...
To finish. That's why I like to long trade, because you never know short term. Long term, I always believe my picks are going to win. But short term, I don't know what's going to happen in the market at times. That's why I long trade. And I also have in the back of my mind, I know that if it goes down, I can always buy more. That's why I long trade as well, because I have that option as well. So I'm never forced, like I was in futures, to have a margin call. You know,
that makes sense.
And I had a very horrible experience with futures, and that's why, even though I paid $1,500 for a lifetime contract with Ninja Trader, which I currently still have, I don't use it because it's so risky. I just leave it there. Like, maybe one day I'll go back to that. But it's just so scary. But this seems a lot more friendly. This seems like a lot less risky. And I'm playing with over 6 figures in my trading account. So I could throw, a few $100, a few $1,000s at options and give it a shot and just play around and see what happens.
Absolutely. And talk about leverage. I mean, you could either buy 100 shares of Ford and hope it goes up, and that would cost you about $1,000, or you can buy a call option contract for a little bit less than $50 and have almost the same effect in your account. All right. So, and what kind of leverage is that? That's like, if it's $100, that's 20 to 1 leverage, $50 versus 1,000. Yeah, that's 20 to 1 leverage. Huge. All right. And you're only risking $50. Now, here's the mistake people make. They say, wow, it's only $50. I'm going to spend my whole account on Ford call options. Okay. I have $10,000 in my account. I'm going to buy $10,000 worth of call options right now. Remember, these call option contracts can go to zero.
Yeah, they can expire. So you would lose your whole 10 grand.
Yes.
Better to play with a portion of your account.
Small portion.
Yes.
If you only, on any given trade, if you, let's say 5% of your account, no more than that should be on any one trade, okay, including options. All right, especially options.
Yes.
Really should be like 1 to 2% of your account.
I agree with you. My strategy is I never spend more than 10% on one trade.
Yeah.
That way I can lower my costs. I'm diversified. I've got at least 10 other companies I'm invested in. And if one is down, I don't have to be forced to sell it. If something else is up, I can sell what's up. It allows me to give me liquidity. So let's just, because we've been live for now an hour and 4 minutes, Dave, and I know you're busy and I'm busy too, so we're going to say bye to everybody. This has been a great show. I've learned a lot. I got 2 pages of notes, Dave. I got 2 pages of notes, just so you know. Legitimate notes that I've been taking. Thank you so much for this. I think I've learned a lot myself, and hopefully you guys that are watching have learned a lot. 3 things that Dave has said we're gonna reiterate. The 3 factors that affect options trading. Number 1, price. Number 2, time. Number 3, volatility. Correct?
Yes, that is correct.
Perfect. There are put options and there are call options. Put options is betting that something is going to go down without losing more than what you're risking. Call options is betting that something is going to go up in a certain period of time. Always
within a certain period of time. Right.
Man, I think I've learned a lot today, Dave. Thank you so much, man.
Awesome.
You are
thank you, and thank you to your listeners who pointed out, yes, CGC and Kronos, they do have options. I've never tried it before because those things are already big movers already. They behave like options.
Absolutely. They're on fire, and since you trade options, you might want to take a look at it.
Yeah. Well, I mean, they're already volatile enough. You already get leverage basically with just by buying Kronos, or imagine leverage on top of leverage.
Yeah,
that may be more than I'm. But it was CGC, Kron, and TRLY. I think was the other one, or
TLRY. Tilray is on fire. They're at $55.
Yeah. Okay.
Kron is been doing really well. And CGC's been doing really well. And another one that's moving really well today is Afria, APHQF. I don't know if you get that one, but it's been on fire today too.
That one is not optionable, unfortunately, but you can just buy the stock, and it moves so much you don't even need options. Trust me.
All right, David. Well, thank you so much, man. This has been very informative. Hopefully, we can do this again really, really soon. And if I buy some options, we'll talk about it again, and we'll get into more detail.
Yes, by all means. Yep. We could even maybe an option trade live, or at least an options paper trade live.
Absolutely. Cool. I'm totally into that. I've learned so much today. Guys, go to David Moadel on YouTube. Subscribe to his channel. I will put a link to his channel in the description once we are done this live stream. We are so happy that you guys have been here with us for over an hour. Remember, if you're not winning, you're not watching. This is David Moadel and Rich TV Live talking options trading 101. We're out. Peace.